Hello and welcome to another year, 2026. I'm with my good friend and co-host, Evan Lucas.
New location?
New studio,
Yeah.
new location, and of course a live announcement basically from the RBA. So stay with us for the next hour or so because we've got a lot to cover. We are going to take a deep dive, obviously, into the Australian market, where before the announcement at 2:30, we're going to go deep and rich into the inflation story, because obviously that's the trigger for why we are at a live call here today. We'll obviously announce in a minute or two in terms of what our predictions are of what Governor Bullock and the Reserve Board will do today. But we'll also then start to fast pace into the Australian economy, but hang around because we're also going to debate the US economy in some serious detail, right? So we are going deep on the biggest economy in the world, which is about 20% of the global economy. And we are going to steel man and stress test the Trump experiment as we move into his second year of office, because it has been an extraordinary 12 months in terms of the pace at which he is.
I'd even argue it's been an extraordinary 2 months since we last spoke to you in terms of what's happened there. I mean,
so much for the summer holiday break.
Yeah,
it's been
there
a lot
was
of reading
no summer holiday break for us.
Okay, so we are going to go into that. So before we do so, just a reminder, we're going into, this is our February economic update, and at 2:30 we will take the feed from the RBA website to see what the announcement is, and we're both willing to unfortunately predict that the cash rate will move higher based on the data that we've looked at. So
it would be pleasantly nice if we're wrong.
We would be thrilled if we are wrong, but that would probably send the wrong signal.
It would send an incredible signal.
The wrong signal to government spending and the wrong to consumer spending,
yeah,
which we'll talk about more. And then obviously we'll go into the other important data sets, which is around the employment story, around the consumer confidence, business confidence, and what's happening in that particular space, because it would have been a fascinating 2 days to be a fly on the wall at that board meeting, because there has been so much that has changed, and we're a little bit of an outlier. You know, this tightrope that we were walking, we just seems to have got wobbled.
Before we left you guys at the end of 2025, I'm very lucky to have the ability to talk to the guys at the RBA, and you can see the change. You could see they were getting worried in October. Yeah. Like they were starting to say, actually, hang on, this is not what we expected to see in the transition down to lower interest rates. Because don't forget, last year, 0.75% came out of the cash rate.
Yep.
They were watching to see if they were landing the plane with a narrow path.
Yep.
And I think what it is actually, it's not about a narrow path. The plane took off again.
Well, it was always an experiment, right?
Yeah.
Like this time, the experiment was a lot different, because what we've been talking about for the last few years is that the government and obviously the RBA tried to keep unemployment at the lowest level that it possibly could. So this new experiment was retain employment and go slow to bring but what's actually happened, as opposed to
very Australian, right?
Yeah, well, compared to, basically pull the Band-Aid off.
Even our friends across the ditch in New Zealand.
They did it. They took their medicine.
Yeah, I mean, look, the Kiwis went too hard. But you look at what happened with the Bank of Canada and how they managed the Canadian economy, which is probably the closest to us.
Yeah.
They did go harder. And then again, you're right to argue that. We always argued that we hadn't got to this point with an employment situation in 3 decades. Yeah. We want to keep the gains that we've got out of the back end of COVID. So with that in mind, we're going to go slow and steady on the way up. And also, therefore,
so I don't mind trying experimentation like this. I mean, if you look around Australia and you've been on holidays, there's a lot of people that are doing okay. All right, we keep talking about this, housing crisis and also this affordability and cost of living crisis, and that will come into the narrative again. We understand that if there's more than one increase, but the vast majority have employment, and ultimately their savings ratio is still climbing. So it says that they're doing okay, and certainly the older population with the higher interest rates are also earning a little bit more money. Share market's been doing okay. So more broadly speaking, has the experiment worked? Well, we'll know in a couple of sort of years when we can sit back and digest the whole cycle, whether it did work or whether it would have been better to go harder earlier. and just take that medicine early. But let's talk about why we find ourselves in this situation. First of all, this is not a problem of this current government, but they certainly haven't really helped us in terms of the current energy crisis that we've got. Our cost per kilowatt hour is embarrassing compared to the rest of the developed world in terms of our economic disadvantage that it's causing us, and that is a throughput that then also flows into lots of input costs around energy. And then the other one is the government spending. So again, the Labor Party, with their no one left behind mandate, has been spending like drunken sailors and moved the GDP spend.
27% of GDP. So
before that was 23, was sort of the gentleman's agreement.
Yeah. So outside of COVID, we need to put COVID to one side.
Correct.
This is the highest level of of government spending to GDP since 1986.
Yeah.
Now, the other thing that's so concerning about it is that from leading into the election versus the mid-year economic update we got in December, there's a $56 billion discrepancy.
Yeah. And don't forget the extra $25 billion boost into health.
So this is also the relationship between the feds and the states.
Yep.
Right. So the feds collect it, the states spend it.
Yep.
And there's an argument that actually what they've been doing is pulling out money into the states to do the care economy. Yep. So aged care, healthcare has been where most of it's been. The NDIS, and despite the change that's supposed to happen around, the autism,
trade-off,
the autism stuff.
Yep.
Again, the argument's been made. Who's picking up the bill of that?
Yep.
They've just announced they're going to push it back by 6 months. So you'll hear this a lot. What's been said and what's actually been done aren't lining up at the moment. So we better keep moving because we're going to get into time. But let's talk about what matters.
So what we're seeing here is obviously the trend in the consumer price index. So this is our inflation tracker, the basket of goods, and we can see that the RBA through the ABS has been getting new improved data points in terms of monthly versus quarterly, but there's still a lot to happen here in terms of washing that through. But we just wanted to show you where the concern lives in terms of, now we did say, the RBA did come out and say we expect a little bit of a bump up, but it looks like that trend is now becoming more of a threat to be embedded, and that's basically where we sit.
Yeah, and so caveat back on that previous chart too, the RBA has openly said that until we get through probably 18 months of data, the monthly data, which is now why there's much more lines than the ones, 2021 where we are, because they're only quarterly ones, that will be bumpy, which brings me to this. So Ben and I, off air, before we came on to see you, were asking the question, can we make a case about why they will hold rates? And this chart in its own example probably puts a stop to that debate immediately. There is nothing else to say, but you can see a very sharp re-acceleration of inflation, both at the headline and at the core trim mean level, outside of that sort of tan cream band, which is their target rate. What's also important, why I deliberately brought up the monthly numbers versus the quarterly, RBA is still using the quarterlies for today, and this is quarterly data, and you can see that it's 2 quarters in a row now that we have bounced out of where we were, and it is not just bouncing out, it's jumping out quite rapidly.
And so the governor was making a case, and so was the assistant governors, that needed to be broad-based. So they weren't going to necessarily, basically do a knee-jerk reaction.
On just housing, for example, or what have you. So,
but here's where we see it in both the goods and services charts.
One that had got us away for a lot of things, we spoke about this lots last year. The cost of goods at one point was going at about 0.4 at the bottom, got to about an average of 0.7 for several quarters in a row, which was great. The one that we always get back to is services. Because services, which is that dark blue line, we are a service economy, but services hairdressers are a good example. They will absorb costs for as long as they possibly can until they burst and they can't, and then they transfer that through to
inflation, rent, all of those are part of the services.
Which is why they're also sometimes called sticky inflation, because they take 4+ months to put it through. The catch is, you can see with that chart, it's ticking up again, both of them. But more importantly, services is nowhere near getting back into the 2 to 3% handle, and that's a problem.
And so when we go and break it down, we can see here, I want to spend a little bit of time talking about the weighted averages, because if someone, let's say you're the first time you've had a mortgage is in 2025, you're going to have to learn about this stuff, because obviously this is the blunt instrument in terms of what sets the cash rate for our variable mortgages. And that's why it hurts us so much. So we can see here in terms of the weighting, you can see food and non-alcoholic beverages, 17% of the weighting. Housing. Now, housing is not necessarily the price of housing. We need to remind you that it's rent and also the input cost on new builds, okay, and energy. So that's where energy sort of fits in predominantly into this mix, and that's why it's got that higher weighting. Then you got transport, which is also the secondary energy, which is the oils and all of those other inputs, and that makes up 11%, and 13 is recreation and culture. Well, we have been having a good summer, and we did spend a lot, because when you saw the monthly inflation data, spend on recreation, transport, travel, holidays, off the charts.
We'll come to that, because the other thing that I'm glad Ben's pointing out to you here is that you can see on the right-hand side what impact that had on the total contribution to the headline CPI. Now, remember this, food and non-alcoholic beverages get stripped out, along with things that are in there that are around electricity and transport, so that gets stripped out. Even with it out, though, it's still showing that we're going at 3.3%.
That's when we get our trim mean or core inflation, when we take out those volatile items.
Yeah, but as Ben said, if we go to the next chart, this is why it's broad-based. So
I got the highlighter pen out.
Ben's great clip art.
I got the highlighter pen out. I clip arted, and I said, "This is where they need to be. Let's have a look where they are."
And you can see that there is over 2/3 of all groups in the CPI are not only just above, but well and truly above that band. You're right to highlight, so the monthly movement in recreation and culture. Let's also talk about last year, because don't forget, we got 75 basis points of rate cuts. If you take the Australian average, which is 660,000 for a mortgage, it's about $1,500 per annum. What we know from the spending data and from the credit card data, we spent it. We gladly spent it. And we absolutely rightly pointed out that public expenditure at the moment is too high. At the moment, public fighting for private and public investment is too high. Infrastructure is a great example. Public enterprise, private enterprise are competing for the same amount of supply of goods, people, human capital. But, and it is a but, this chart's telling you that it's not just the government, it is us. Now, the other caveat to that is that part of the reason we can do this is because the government is giving us money.
Well, they're employing us at record levels. So there's more people working in the public sector than the private sector. And that is the problem. So
it's a strange thing to give everybody a cuddle, right?
Give everyone a job. So, and that's not just at federal level, that's also at the state level. And so, you know, when we talk about fiscal and monetary policy working hand in glove, we haven't really had that for the last sort of, well, almost 2 years, is we've sort of played popular politics. So whenever there's a problem, the government needs to throw money at it, and they throw money at it so they stay in power. And so that's what we're basically seeing. And so now they were hoping that they can, you know, pull their brakes on their spending in, and then that the investment will come from the private sector. But at this stage, there's still too much pressure on the public purse, and they're not reining in their spending enough. And they're keeping us all employed, and they're giving us pay rises without any additional productivity, which we're gonna go deep on productivity later in the episode.
But also coming back to, I want to point out very clearly, we understand that you are spending because you have to on essentials.
Great segue.
Brings into this, right? So this chart shows that those non-discretionary spending things, those things that you cannot do without. So, you know, food, energy,
shelter,
education, health, right? They're the 5 things that are referred to as the essential spending, non-discretionary. As that green line tells you, basically since the bottom of this whole scenario where we got back into a little bit more line, everything was looking hunky-dory, that we were going to get back into landing the plane, that's what's taken off. Now, health and education, that's controlled by the state. So those two are where you can put it straight through, and that's spending on. And when
the government's the buyer, it's always inflationary. It's always inflationary when the government's the buyer, because they've got to buy it. And so the providers just keep putting the prices up.
What's also interesting is that transport at the moment, with lower oil prices, has been offset by the rapid increase in energy. And that's the other story that came out of the figures. I mean, you've got the chart. Bring up the energy chart, which is next, because we'll come back to that later. But 21.4% was the jump in energy prices.
Annual.
This chart, this just to show you how independent this is purely straight off the Australian Bureau of Statistics. This isn't something we've put together. This is actually what anybody can access at any point in time. And they have been doing this chart basically since they put in any form of energy rebates. And it shows you that without those rebates, which are those EBRF numbers across there, which includes federal and state versions, that we'd actually see energy prices from the end of 2023 or mid 2023 would be about 21% higher. And what's also clear from this, we still haven't gapped up on it. So we still have time to go on that figure.
Which just absolutely, reinforces to me that energy is one of the problems that we have to really have an honest conversation about in terms of the energy mix that we have in society to bridge the gap to get us to, obviously, renewables. We're going in that direction, but there's still a fundamental need for low-cost energy to be competitive and to attract the investment dollars that we need in this economy to keep it growing, because there's two ways in which you grow an economy. If you spend the government's money to grow the economy, there is a debt trail behind you, and we as the citizens of this country have to pay that debt back. And if we let that debt get too big, with too much interest payment on that debt, the only way we pay it back if we can't grow the economy is through higher taxes. So it means even though what the RBA's mandate is to reduce inflation, to ensure that we have stronger consumer buying power or purchasing power, as they call it, that's a good thing. So public investment over time, too much of it becomes a drag on the economy. Private investment, after the back of our gold rush and our, building the economy off the sheep's back, the last 100+ years, the economy has grown through private investment, through that being mining, through that being any other types of investment in critical infrastructure. So all of those things have led to the current conditions that we have as in a country. And, grade our economy, it's probably a B-, a C+ in terms of how well we perform, and we'll take a deeper dive against the US economy later on in terms of part of that story. But it just says to me that we've got to have this honest conversation around energy. Rebates are, again, sugar hits. They're vitamins rather than anything else, because we then rely on the government to bail us out in terms of that, and that's a problem in terms of how we see the economy.
I would argue they're worse. They're indiscriminate. Right?
That's terrible.
So because they're indiscriminate, they don't actually target what needs to change.
No.
So energy, completely agree with your story. The caveat that I would put into with what's on screen, with what possibly could be argued, okay, in hindsight, maybe, but what you're talking about, and we'll come back to the US in a minute, I know we're a minute away from getting the RBA, but Australia is not great with risk. We are a very risk-averse country. We take things very conservatively. We like to have the ability to sort of have what I refer to as the singularity. The numbers tell us the answer, right? So if we don't do X, we will therefore don't get it wrong, and therefore keep going. So with this is why I asked this question. If you wanted to be a bit more risk assertive and to actually assist our issues, I've said this before on this program, which is they could have maybe interfered with construction costs, right? If they subsidised lumber or subsidised concrete or subsidised other critical construction inputs and were putting a rebate into those, then at least then you've driven down the cost of construction, which therefore allows you to increase supply at a lower price.
Evan, I'm a voter, and you're going to give me something. Versus if you give me that money to the business,
I know that. Yeah. But this is this is the chicken and the egg. Who takes the responsibility? Do we actually, as an electorate, have to accept that we need to stop relying on the government for what we're doing? I understand we're 20 seconds away, because what we also
but we can't. Only because we've been taught that basically the government fixes all of our problems. Then we have to have a bottom out, and then ultimately after the bottom out, we go, we did need to do that. We do need to be fiscally responsible, because it gives us longevity around what that story looks like. All right, so let's now refresh if I've got this right, everyone's refreshing at the same time
Yeah, it's freezing
on
up.
the cash rate. So it's frozen up because everyone wants to know the answer in terms of what's happened to the cash rate. And it's still showing December 10. So from that, there it is.
It's gone up. So
25 basis points.
25 pips. So I'll let Ben talk. I'm going to read into it. But as expected, 25 basis points were put in to the cash rate. I think what you need to look at is that the first 3 paragraphs, as you'd expect under the new thing, is to actually, in fact, it's a very short statement because it's the new one of the year.
All right, have a look at it whilst I just talk to the story. So let's wrap up the situation that we're in. Unfortunately, it is a blunt instrument. We are going to blame the RBA for this difficult decision, and that's what the news reels will show in terms of that. But unfortunately, they've got a job to do. They're the independent umpire in terms of how much cash they release in the economy to get the economy to be able to be growing without getting too inflationary, because inflation ultimately kills our purchasing power and reduces our living standards over time. It means that our money is caught up in costs that don't necessarily bring us a greater good. And so they've had to do this particular measure. Now, 25 basis points is the first. What I'm interested to know from Evan after he gets through the statement here is, are they signalling that this is potentially one of several, or are we just pumping the brakes to send a shot across the bow to say, everyone, including government and including consumers, just get back to what we've talked before about in terms of keep your money in your pockets for a while, slow the economy down, slow unemployment down.
One line.
Yeah.
The board judged that inflation is likely to remain above target for some time, and it was appropriate to increase the cash rate target. That is saying for some time, then they will continue to do the work to get it back down, and therefore you cannot rule out one more.
So there will be data led, I'm sure, as part of that particular story in terms of what that looks like.
It's that data led. It's even more, the language has changed. The board will be attentive to the data and the evolving assessment of the outlook. So that is stronger language, much harder view on inflation, very much talking about the fact that one of the other thing they point out, their capacity pressure reflects in part greater momentum and demand seen in recent months.
Yeah.
Growth in private demand has strengthened substantially more than expected. So that's what we talked about before. Yes, the government is certainly spending too much at 27% of GDP, but we're taking that money gleefully and putting it into the economy with price pressure. You cannot, with this statement, rule out one more. I don't think it says more than 2 in terms of, again, reading the tea leaf. Let's call it what that is.
Yep.
But they have signalled very clearly they are now very worried that we are at capacity, probably at around 4% cash rate, so 4.1. But about capacity is 4%. And under that, we accelerate too quickly to put upward pressure on price demand.
And look, as I said, we're going to sort of do a comparison between the US and the Australian economies around economic or capacity constraints in the economy, because it's frustrating for me when I see our economy hitting these capacity constraints when it's doing 1.8 to 2%. And we're seeing the biggest economy in the world growing at a clip of 4.4% on a quarterly basis. So we're going to get to that. Let's now unpack some of that other data whilst Evan also just studies the reactions of the market. So I want to talk about the unemployment rate and the participation rate. So what also would have played on the minds of the board and the RBA is just this whole story of a drop in the unemployment rate. So our seasonally adjusted unemployment rate fell to 4.1% in December from a reading of 4.3 in November, below the expectations of a reading of 4.4. It marked the lowest jobless rate since May, as the number of unemployed people dropped by 29,800 to a 7-month low of 628,600 in December, from 658,400 in November. Among them, the number of people seeking full-time jobs fell by 21,400 to 421,700, while those looking for part-time work shrank by 8,400 to 206,800. Meanwhile, employment rose by 65,200 to a record high of 14.68 million, well above forecasts of a 30,000 person gain, rebounding from an upwardly revised drop of 28,700 in November. full-time employment rose by 54,800 to 10.10 million, while part-time employment jumped in that season of December by 10,400 to 4.48 million people, including our 15-year-olds to 18-year-olds who are finishing school and getting a school-type job. And then obviously our university students are also finishing their degrees.
Every year you see in December that there's a big spike in that age group, the 25 to 24-year-old bracket, and that's been highlighted. It's particularly that 24-year-old group, which is great. They're the ones coming out of university and are actually entering the market normally in January, which is also why in January you see this quite nice boost of employment.
And the participation rate ticked up to 66.7% from 66.6% in November, but below estimates of 66.8%. The underemployment rate decreased from 5.7% from 6.2% in November. Additionally, total monthly hours worked across all jobs advanced by 8 million to 2,001 million hours.
Yeah,
that's right, 2,001 million hours. Look, that's an improvement in productivity, so we will take that.
Also want to ring fence out. You need to also remember that the employment data is good.
Yeah.
Right? So this is the double-edged sword with it, is that participation rate has never been higher.
Yeah. Almost record highs.
Yeah. The level of female participation rate is at a record all-time high.
That's great.
As Ben just pointed out, hours worked is also moving towards a record all-time high. Output is actually moving. So the employment is great. The catch with it is that if we feel stable in our jobs and we feel stable in where we are, it does increase spending. Double-edged sword. As I said, I just want to understand that if you've got a job, that's great. And not only that, it gives you a confidence that goes there. Don't be upset with good employment. This is going back to what markets got a really bad psychological impact themselves on in 2010 through to even all the way through today. 2019, bad news was seen as good news and good news was seen as bad news because it created a market reaction to the inverse, because good news meant we won't get a rate cuts, right? And back in those 10 to 10s years, those 20, two tens.
Rates were higher.
Rates were lower. Right?
Yeah.
So the risk around rate rise, blah, 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 wasn't there. It was more about we just want more free capital, capital. And we've got into this lull that's the norm. Now we're on the flip side of that. Admittedly, COVID's thrown the wrench in. But we're now going back to what's actually probably more a stereotypical 80s, 90s sort of period.
Well, I mean, you look at the tightening that's happened here in terms of the ANZ, Indeed, Australia's job ads surge, because this is the story that we also want to
keep going.
It's popped again. So just from that point of view, this is what throttling the economy does. It's meant to slow down jobs because it's meant to slow down the investment in the economy at both sides. And that's what we were seeing. But you can see that the last chart there, that we did see a surge of 4.4% month on month in December, rebounding sharply from a revised 0.8 decline in the prior month and marking the first increase since July. It's also the strongest monthly expansion since February of 2022, indicating a renewed pickup in hiring demand towards year end. The rebound likely reflected seasonal recruitment ahead of the holiday period, easing concerns over economic slowdown and continued resilience in the consumer-facing activity. The consumers are spending. Gains were concentrated in sectors such as retail, customer service, food services, which typically see these stronger staffing needs later in the year. On an annualised basis, and this is where it is important, because this could be the only thing that could potentially weigh on the Reserve Bank outside of the inflation story, is job advertisements fell by 3.2%, but still remain 11.8% above pre-pandemic levels, underscoring a still tight labour market despite some cooling from the earlier peaks. So we're going to keep looking at job ads, because we think that that's going to be a leading indicator in terms of where the economy is heading. Let's move on to consumer sentiment. And what we wanted to see, the big highlights in the January numbers were from the Westpac Melbourne Institute's consumer sentiment slipped 1.7% to a reading of 92.9, still in pessimistic area. January from a 94.5. Deterioration views in the near-term outlook was the reason for the move, and that's off the back of
being told we're getting interest rate
hikes.
Right. Now we're here.
So we're here. So we've obviously got consumer are less confident, also about job prospects. So that does say to me again where this sentiment debate lands is going to be important. If we keep our money in our pockets, then the reality is the RBA won't have to do as much tightening as possible. Less negative on time to buy a property, so you can still see time to buy a property is currently sitting at 89.6. So that's still not too many people are sort of optimistic versus pessimistic about that. But of course, house price expectations still ridiculously high. And this is reading into that narrative of first home buyer 5% deposits, really chronic supply shortages. So people just expect prices to go up because the economics of supply and demand are in balance at the moment, and that's pushing prices higher. But the time to buy a dwelling, people are sort of saying, well, maybe if price is a little bit too high. That's the debate that's going on there. And you can see interest rate expectations also sitting quite high at 152.8 in the latest reading, which was a 5% jump from the previous time. Looking at business confidence, this one is the interesting one, right? Because this is what was meant to happen. We were meant to have this, narrow path, walking this tightrope, landing the plane, which is what was happening September, October, November, December last year. And businesses were meant to pick up the slack as governments pulled in their purse strings. And so we saw the NAB Business Confidence Index edge up to a reading of 3 in December from an upwardly revised reading of 2 in the previous month. Meanwhile, business conditions strengthened, driven by gains in both sales and profits, whilst employment held steady at a reading of 4. Price measures ticked higher in the 3 months to December through capacity utilisation eased only slightly to a still elevated 83.2%. Now, the survey is consistent with the view that momentum improved in the Australian economy in the fourth quarter, was the read from the chief economist, Sally Ould, noting that elevated utilisation was broad-based. So
it's interesting because reading her even further, she was actually the one that really first started to hit the nail on the head around the issue around capacity.
Yeah.
So if you look at the business confidence numbers report that she's been doing all the way from around about September to even the one she just released a week and a half ago, from when we're speaking to you, is she keeps pointing out that the capacity level in their survey was at 86%. Wow. Right. With that, so in the scheme of things, that's full capacity.
That is.
Right?
There's not much you can scratch out from there.
Yeah. You've got 14%. There's no such thing as 100% capacity. It just doesn't exist. And so what she's arguing is businesses telling you that they are doing everything they can. The pressure is still there from demand. So the only option is to basically jack up price. That's what capacity is.
Test the market.
Yeah. So you've got
consumers willing to pay more.
Yeah. Workforce,
higher inflation.
Equipment, workplace. That's their 3 categories, and all of them are there. So that, you can't do that. Just before we go any further, just to sort of tell you how much of a reaction to it is. The Aussie dollar is always the way to look at it. It's almost up 1% since we spoke. So that would also go back to the conclusion about another rate rise. So the market is saying, yep, we're of the belief too that they have signalled this is the first of possibly 2.
Yeah.
It's not being so hard that it would suggest 3, but they're saying very clearly that the first half of this year, we expect another one. So there'll be half of one up there. And particularly against the US dollar, that is also, again, we'll come to the US in a minute, but Jay Powell and co are not signalling any rate cuts happening in the States in the next 6 months. So with that in mind, the US dollar should be flat, stable because it's not moving, but the Aussie dollar is jumping because we are going to see rate rises.
Well, yes, but I mean, obviously with the incumbent new Fed chair, that's going to be fascinating in terms of what happens there.
Kevin Warsh is a story we'll come to in a minute.
We'll be debating him over the course of the year. So let's round out the property story to bring home the Australian market update. So we saw quite a strong, solid January number of a 0.8% increase. That was off the back of, remember, Sydney and Melbourne having a decrease in the previous December numbers. And we can also see the strength that's also happening in the regional markets based on 2 things. Investors chasing what they call good deals in the regions, but also that affordability story that's also playing into that. So we saw that sort of happening. So we saw, if we take Melbourne and Sydney, what we did see there is the mid-size caps were outperforming. So you can see some of the strong numbers in there. Perth 2% for the month in January is just incredible. 1.2% for Adelaide and Brisbane also very, very strong at 1.6, Darwin 1.5. You can see Melbourne just scratched out only 0.1 of 1%, Sydney 0.2. So they are clearly outperforming, as is the regions. You can see combined regions was a 1% rise, and the 0.7 was the combined cities. And remember the weighting in this, Melbourne and Sydney actually have a higher weighting. So that's what's brought that number down to the 0.8 overall, considering when you got 1.2s and 1.6s and 2%.
What fascinates me, though, is that Melbourne is now the 5th median value out of the big 5 in the country.
Watch this. Well, it just at all. This,
well, I agree with you. Watch this. But
well,
for me, that also shows exactly what you're talking about, which is the 3 markets that are clearly overrunning, which is Brisbane, Adelaide, and Perth.
Yep.
They are. I mean, Sydney's a different beast, but it will be fascinating to see, because part of the attraction over the last 5 years has been Victorians, particularly moving interstate, and the attraction of particularly Brisbane and Perth.
Yep.
And the lifestyle it brings. Brisbane for me is the one to watch. I'm again listening to old Victorians that are like, hang on a minute, it's actually so expensive up here, I have to consider about moving home.
Yeah. Well,
so that's the next question about the market that will happen.
There's no doubt that there will be
$1 million
flex.
Median house price in Brisbane.
Well, 1.1 for a house.
Right.
1.1 versus Melbourne is basically just under $1 million.
Yeah.
So
it's incredible.
So I'm going to do a deep dive into the market outlook for property in a couple of weeks' time. So stay tuned for that, because it will be an extensive deep dive, because it highlights again what I've always said is, while supply and demand is the voting machine in the short term, the weighing machine is the economic activity. If you run in a strong economy, you'll have really high house prices. Doesn't matter where you are. Any capital cities around the world, if they're the strong economic engine houses, they have high land prices and they have high housing prices, because they've got great jobs there. Because they've got high paying jobs because of the economic output. You don't have those in the regions. That's why it could be a false dawn or fool's gold in some of those areas, unless it's commutable to a major capital city. So a couple of things I just wanted to add. The conditions still bode well for price growth, and just some stats that are important to that. So stock is down 19% compared to the same period last year, and about 25% below the long-term 5-year average. Sales, interest and activity was boosted also by first home buyer 5% deposit scheme. So the ball still rests in the seller's pocket outside of Melbourne at the moment. But I do think that, Melbourne is just one of those markets. You look out here at our beautiful city and you can't see, but we've got a lovely view of the city these days in our new studio, that's going to be a thing. So I will be talking more about what's going to happen in Melbourne in my update coming in a couple of weeks' time. All right, so let's round out the story of what the Aussie story is. The RBA, are they one and done?
No.
Evan's saying no.
And not that, they are now coming, so there has been 4 different economists from different places, I don't need to name who they are. All of them are saying this is suggesting that we are not done.
And we'll be watching her interview very shortly in terms of what happens.
40 minutes,
yes.
She will be live, and we will be watching that very much, because,
yes,
I'm not the only one saying this, nor is Ben.
No.
The analytical world, reading what's going on there, not only that, looking at the statement and along with the monetary policy statement, it is strongly worded that upside risk is too high.
Too high.
And we need to get a cap back on it.
We need to cool the jets. So fiscal policy still remains something that we want to be focused on, but we're also now coming after the consumer again to say, you know what, change your spending habits, make sure that you, again, teach business that at the end of the day, your dollar is valued and they need to be thinking about what price they put in front of you and whether you accept that price, so that keeps that inflationary pressure under control. Right, start of the episode, we promised a deep dive into the US, and have we got some intel out of the United States of America?
This will be fun.
So I want to start the update in the US just with a caveat at the start. These are not my opinions, and I'm not necessarily in support of what's happening in regards to Trump's economic experiment, right? And his general experiment in terms of running the economy. But what I did get to listen to was 2 fascinating long-form interviews with Scott Bessent, who is the US Treasury Secretary, and Howard Lutnick, who is the US Secretary for Commerce, right? Now, they laid out an interesting game plan on the podcast that I listened to out of the US. And I just thought it's really important. Now, I've asked Evan also here to steelman some of these points, because there is obviously differing views. And if you take in terms of what the consumer in America or a voter in America is feeling, some of the narrative that's coming out of the Trump camp and Fox News and all of that supports this very strongly. And of course, you have different narratives coming out. But it's important to understand what their intentions are and what they've been doing. So here's what we were talking about here. In terms of the reason why they're going after tariffs is to try and even up the trade imbalance. And the trade imbalance is simple, that they import and they spend more on goods coming in, allowing businesses offshore to build things in their country and then sell them to Americans. And the differential is so large in their mind that by introducing tariffs means one of two things, that those importers will have to pay more and we will get revenue for the government here, or they can pack up their operation and bring their factories and bring their production into America and employ Americans to do that work. So that's number one in terms of, I'll do one more and then you can jump in. Tariffs have been used as leverage as part of a negotiating tool. So what are they trying to negotiate? They're trying to negotiate foreign investment. And so there's been lots of promises from Japanese governments, from the Euro area, from the UK, etc., about investing into America. Because if you're investing into America, you have to pick up American jobs, right? If you're going to invest that money, it will actually grow the US economy, and that'll be part of that particular story. So that's what they're doing when it comes to using tariffs as part of that negotiating tool. So the UK only got 10%, and then Japan got 15%. And there were all of these little debates and negotiations going on, all part of a bigger economic story on strategy around bringing all this money or bringing all of this production back into America.
So evening up the trade balance is an interesting one, because the trade deficit in the US widened to $56.8 billion in November.
Yep.
Largest widening in over 4 months. It's the worst print since the forward bringing of stockpiling.
Yep.
So the evening up of the trade balance history, every single time we've seen tariffs used as a way of using leverage, this has led to that. Because actually, if you think about what they're doing, you are going to create an imbalance, because you have to bring product in at a higher price, the imbalance happens. If you look at tariffs as leverage, this is the fascinating one. Don't forget how tariffs work. It's the US consumer that pays for it, because you don't pay tariffs.
Because I'm debating with you. So if the foreign importers don't actually take it on. So in other words, if they retool, they remanufacture or make their goods cheaper, they take the hit. Do you know what I mean? So you see, so that's Bessett's argument. I'm not saying it's right. I'm not saying it's right, but that's the argument they're putting forward.
Yes, but also what we've seen is the revenue generated is nowhere near what they are saying.
No, and
in fact, it's about a quarter.
Correct. And Bessett was even saying that's not the big part of the strategy. If you actually look, Nick was definitely saying he was the one basically. It's the spin. They're spinning, but he's saying it's definitely going to.
Getting back to my point, tariffs is leverage. Tariffs is a negotiation tool.
Yep.
Also foreign investment. The Greenland experiment is the great way to answer those 2 points. So what we need to remind ourselves, yes, both the EU and Japan have agreed to invest upwards of $200 billion
Yes.
into the US to manufacture certain things. The thing is, though, Japan has actually signed an agreement to start that in 2027.
Mm-hmm.
So we still haven't had any of that money come in.
No.
The EU was about to pass that through Brussels when Greenland came about. And they've now stopped all negotiations around it. The signing of it has not happened. And at the moment, under the EU parliamentary debate, it is now it's not going to be put into practice until May.
So good. So good to see the rest of the world sort of saying, well, we're not going to be bullied by the strategy, and the answer's somewhere in the middle in the negotiations.
Negotiation tool.
Correct.
Wait. Negotiation tool if you bully and use exceptionalism as your basis for all of your negotiations, you are believing that your bully will take it. What has happened in the last 2 weeks? The EU just signed a deal with India that makes up 25% of global GDP, right? And it's the biggest free trade agreement the Indians have ever signed. And it is the fastest growing market the Europeans have got into since China. So if you're going to bully your largest trading partner, which they are, the EU is the US's largest trading partner, they will find other markets. And so get this, understand it completely, history is repeating itself. So if you go back to Harley Smoot back in the 20s, where the US federal government did something similar, it actually led to larger imbalances, lower taxation takes, and an acceleration of the Great Depression. That won't happen. I want to make that very clear. But the political argument and the smoke and mirrors versus the actuals, it's history repeating itself.
And so what you're seeing here in terms of Trump's playbook is a situation where he will negotiate extremely hard and then walk back the chicken out, as they say. He will walk back from the taco.
Yeah, there was a new one.
There was a new one as well.
I'm devastated. I forgot what it is.
But I suspect they're also still saying, are they judging their success by the gains that they were able to make in this? Because the biggest challenge that the Trump administration has is they've only got this 4 years. Like, he obviously doesn't have a second term.
2 years.
Yeah, he's got 2 years left, right? 2 years to the midterms.
Yes.
So he's going really, really hard, and he can't wait for the bureaucracy to work. That's why he's super aggressive. Now, I'm not saying it's right. I'm just saying that's a tactic that he's using. Obviously, AI chip and the AI and chip revolution, so large language models, etc., are going to be a thing, GPUs, etc. So that's been massive for them. Now, they're targeting 5 to 6% GDP growth in 2026, right? And that's their way of their argument about getting out of the debt situation they've got, because they've got a very, very difficult debt situation. They are only saved because they're the global default currency. But here's how they're doing that. Structure reform, deregulation, so they're cutting red tape in every area that they can. They've got business investment and confidence, and I'm going to come back to that because you'll see a chart in a minute that the businesses, people are buying into it. Energy independence. Again, I think they're 13 cents per kilowatt hour is their current energy cost. Ours is like 38 cents per kilowatt hour. And if I'm wrong on that, please let me know, but it is in the 30 cents when I last looked at it. And then obviously a lower tax environment. So less personal tax means obviously greater purchasing power and more consumer consumption. And they'll argue this US exceptionalism. Now, where the US exceptionalism does have a case is historically, as the biggest economy in the world, they've been able to do pretty amazing in terms of building out that, building and growing their economy better than countries like ourselves, who should be better at what we do. Now, what I'm going to do in terms of this is put it into context. So the US economy, from a total GDP point of view, is 30.6 trillion. That's $30,600 billion is the turnover, the GDP in the US economy. Now, compared to Australia, we have 1.8 trillion, so 1,800 billion. So we're 1/17th of the size of the US economy. Now, so then you're like, okay, well, that's not a fair measure because look at their population. Of course, their economy's bigger. But on a per capita basis, and we go back to 2024 data because it does take a while to calculate these figures out, US was 86,000 per capita in terms of production. In Australia, we're 64,000. So what does that translate to? On average, each person in the US produces roughly 30 to 35% more economic output than each person in Australia when measured in nominal GDP per capita terms. Now, for those people who aren't watching the screen but are listening on audio, does that mean we're pretty bad in Australia? No, not really. We're still probably in the top 20, maybe even top 15 in some measures. And so we're well above the global average, which is 20 to 25,000 per person per capita. But it's a competitive world out there, and we're fighting for investment dollars to also come here so we can grow our economic pie. Because if we don't grow our economic pie, we use debt, and we use debt to pay for everything, which means higher taxes. And unlike America, who can use debt because they are the default currency in the world, We can't have that luxury because it's inflationary for us when we use that type of debt. Now, here's the chart that I just wanted to sort of bring up. This is if the US does achieve 5% GDP growth, they'll add 1.53 trillion, so 1,530 billion extra dollars into their economy and turnover. If we add 2%, because we've got the capacity constraints in terms of the, that's my problem here. We'll add an extra $40 billion to our economy. So why did I bring this up? I brought this up because I wanted to make sure that people understand, and when you have a look at this chart about productivity, this is my message to our regulators and to our governments and our politicians. Look at these two charts from a productivity point of view, and it's sad that we can't be the dynamic country that we were. We're becoming the tired, lazy, well-settled country that no one thinks about, but that's going to have an impact us on the medium to longer term. So we need to lift our productivity. If we want to get higher wages and better living standards, we've got to produce more. And that's what we're seeing in terms of what's happening in the US compared to what's happening here, because the biggest economy in the world can potentially grow at a higher clip or double, if not 2.5 times quicker than we can grow. And we sit back and say, we could have grown quicker, but the problem with it is we've got all this capacity constraints because of our regulation and all of the things that we put in our way to be productive.
True.
Now, counterbalance that, please.
Yeah, I will. So Ben's right. We have a productivity problem. Again, I said this at the start. Australia is very conservative in terms of how we look at risk, and particularly business risk.
Yep.
We don't invest in ourselves very highly. We don't deploy private capital anywhere near as productive.
We don't have that entrepreneurial spirit.
Yeah. So, I mean,
US do.
You've been to the US many, many times,
Yes.
and I'm sure those out there have. The one thing that always fascinates me when you go to America, and they openly talk about it, and this is, again, the cultural difference.
It is.
We are quite conservative with this. Tall poppy syndrome falls into it, the best way to explain it to you. But also, they will back the billionaire, is their term, right? So even if the whole concept is completely bonkers, they'll back it. Elon Musk, a great example, right? So, the backing of Tesla during the early 2010s was seen as bonkers, and now it's completely, you just there. It's the same with Apple in the 80s and 90s.
Yep. Or Microsoft.
Or Google. It doesn't matter. You can the stories. So unfortunately, there's not. Here is the exceptions, right?
Yep.
So you look at a Canva, you look at that kind of play, you look at an Atlassian. They are an exception. They exist heavily in the States because they will back it, which is why most investment in this country will head over there because the capital will come.
Correct.
Caveat to what you said before. The 4.4% is the growth rate. It's not the annualized rate.
No, that's a quarterly growth.
Yep.
Rate. Correct.
So the annual rate.
Good segue.
Right. So the annualized rate at the moment is 2.3%.
Yes.
So it is significantly different to what the growth rate is. It's coming from a low base. And as you can see, start of last year, right, it was 1.9. It then contracted because we had the issues around inventories, the Trump administration's Liberation Day tariffs all came through in the second quarter. So you are coming from a level that allows a growth rate on a year-on-year basis to do that, but the annualized rate is only 2.3%.
If they get the annualized rate to say 4.5, it will be extraordinary.
That would be extraordinary.
It will be extraordinary. So that's what they're playing for. They're playing for a 5 annualized growth rate. That's what Bessett and Lubnik are promoting out there. Whether they get there or not.
So two things that helped with the 4.4% rate that came into it.
AI.
AI is one of them.
Data centers.
The big, beautiful bill.
Of course.
Right. So
very big spending.
If you, again, we just talked about government spending. Despite, again, all the rhetoric, part of the reason the US is, inverted commas, GDP booming.
Yeah.
Government expenditure went through the roof.
Record level of spending.
Right. So this is, again, all of the talk is about we want free enterprise, productivity, what have you. We're going to do that with a way that was from the 1900s and under the Monroe concept. What we've actually done is that we've just put record level of government spending into the economy.
So we'll see how that plays out because that was their.
So my job is here to sit there and devil's advocate. My job is also here to point what figures you need to read out. Don't forget, during the last quarter, we had the longest government shutdown on record.
Yes.
that also will come through. We are
We're going to see that
currently
in the data.
a partial shutdown, which means that the next time you and I meet, we won't be able to give you the US employment numbers or a few other pieces of data because they are shut.
Yeah.
So
if Donald Trump doesn't like the person, he'll sack them as well. So
or if he doesn't,
imperialist attitude.
So, well, yeah, I mean, they're friends across the Pacific that they like to point their fingers at. The country's starting to see pretty similar ideas.
Yeah, we're just sure. All right. So what we'll do, so we'll see how that plays out. But we've set the agenda for the US in terms of to see how they'll roll out. Now let's wrap up the data for the month of the US, and we'll close out the show.
Because I want to go and watch what Michelle Bullock says.
Exactly. Okay. US economy expanded at an annualized rate of 4.4% in Q3 2025, slightly above the initial estimates of 4.3, and marking the strongest GDP growth since Q3 of 2023. The upward revision primarily reflected stronger exports and a smaller drag on inventories.
Bingo.
Robust growth was driven by firm consumption spending, a rebound in exports and higher government outlays. Consumer spending rose by 3.5%, unchanged from the initial estimate, and the fastest pace in the year accelerated by 2.5% in Q2. Exports surged 9.6%. That's pretty much data centers and AI, I suspect, is what's going out there. Revised up from 8.8% and rebounding from 1.8% decline in the prior quarter as exports fell 4.4%. Obviously, imports and tariffs are having an effect, extending the decline seen in Q2. Government spending recovered 2.2% versus negative 0.1%, whilst the drag, and that was off the back of the shutdown, whilst the drag in private inventories eased significantly, subtracting just 0.12 percentage points from growth compared to 3.4 percentage points for Q2. Meanwhile, fixed investments increased 0.8 below the initial estimates of 1% and slowed sharply following the 4.4% in Q2. So they're going big on energy, they're going big on other things, but that could mean the consumer in America could reject their strategy, because if they're going to have to pay higher prices in their state or town because all of that data centers are drawing all that energy, watch this space. All right, let's go now to looking at monthly inflation data. We saw the US consumer increase by 0.3% month on month in December, matching the market expectations and repeating the rise in September. But I will add, nothing in there that's worrying me too much about inflation. Their target is 2%, remember, sitting at 2.7%. The annual inflation rate in the US remained at 2.7% in December, the same as November. Price pressures eased notably for energy sector, with price rises much slower pace, 2.3% versus 4.2%, driven by declining gasoline prices, negative 3.5% versus +9%, and a moderating in fuel oil inflation, 7.4% versus 11.3%, while natural gas prices rose more sharply, 10.8% versus 9.1%. Natural gas is going up because of the turbines that they're building to obviously power these new data centers. Prices also increased at a slower rate for used cars and trucks. By contrast, price gains accelerated in food, 3.1 versus 2.6, shelter 3.2 versus 3%. Meanwhile, annual core inflation rate remained unchanged at 2.6%, the lowest level since 2021, and below expectations, 2.7%. So we're going to watch this space. What did the Fed then do? Well, the Fed meeting recently left the federal funds rate unchanged at 3.5 to 3.75. Target range for January meeting in line with expectations after 3 consecutive cuts last year that pushed borrowing capacity costs down below 2022 levels. Now, that game plan that we're also talking about, that's the other big thing. They're going to try and influence the independence of the Fed to push the cash rate lower. Governor Stephen,
I didn't have a summer holiday, because we saw criminal charges being put against the Federal Reserve chair.
Investigations to try and
Incredible.
find unbelievable, like only in America. Governors Stephen Mirren and also Christopher Waller, however, voted against the whole, with both advocating for a 25% cut. Policymakers noted that the economic activity has been expanded at a solid pace, job gains have remained low, and the unemployment rate has shown some signs of stabilising, while inflation remains somewhat elevated. The central bank also reinforced that it will carefully assess incoming data in evaluating the outlook and the balance of risk when considering the next adjustment to the Fed's funds rate. During the regular press conference, Chairman Powell and the US economy, he said the US economy is coming into 2026 on a firm footing, and that interest rates right now are appropriate to promote progress towards both the Fed's goals, which is again low unemployment and the cash rate of 2%. Trump will try and have his influence in this because, as we've seen, he definitely wants to influence for lower cash rates. All right, so let's now look at the unemployment rate. The US unemployment rate edged down 4.4% in December from a revised 4.5% in November, which had a marked as the highest level since October of 2021. The reading also came in slightly below market expectations of 4.5. The number of unemployed people fell by 278,000 to 7.5 million, whilst employment increased by 232,000 to 163.99 million people employed. We'll move on. Consumer confidence and sentiment. The University of Michigan's Consumer Sentiment Index was revised to 56.4 in January from a preliminary reading of 54 in December's number. This marked the second straight monthly increase and the highest reading since August, with modest gains recorded across all major components of the index. So consumers are starting to feel a little bit more confident in that particular market. So the consumers continue to cite strains on purchasing power for elevated prices, alongside growing concerns about potential softening in the labour market conditions. So whilst Trump is selling this big dream, the consumer in America is still saying, don't believe you, Donald. And also his ratings in terms of popularity are plummeting. So he's got problems over there in terms of that impact. Also the disgrace that's happening in their immigration policy. Well, don't let me go there. Now, here's the interesting one. This is the one about whether businesses are buying into the story. The IMS manufacturing PMI for the US unexpectedly rose to 52.6 in January from 47.9 in December. Now, that's a material change. You can see it in the chart there. Okay, the reading showed the economic activity in the manufacturing sector expanded in January for the first time in 12 months and the most since 2022, amid improvements in new orders, production, employment, supplier deliveries, and inventories although employment and inventory still remain in contraction. At the same time, price pressures were little changed at 59 versus 58.5. So this is interesting, right? Because Susan Spence, the chair of the IMS Manufacturing Business Survey Committee, said, although these are positive signs for the start of the year, they are tempered by a commentary citing that January is a reorder month after the holidays, and some buying appears to be getting ahead of expected price increases due to ongoing tariff issues. So could it be a false dawn? That's the question there as part of that story. All right, key takeaways. Let's wrapping up the US. It is all about the businessmen in the White House, and they think that they can run the economy better and get out of their way because the experiment continues in terms of what that looks like. The question is, will the Trump strategy work, and will the US consumer and the voter be satisfied? Because we'll find out soon enough. And then, the final takeaway for me, because I always want to bring it back to what's happening, is what can Australia learn? The positives and the negatives in terms of how this plays out, because we do have constraints in the Australian economy, and they don't seem to have the same constraints in some areas. So what can we learn from that? What can we learn from that to bring productivity gains into this market and a mindset to say that we do live in a competitive world and we need to have a few more Atlassians and Canvas, and we need to have a couple of other bigger businesses starting in Australia rather than relying on the government purse to support us, because at the end of the day, that's our money that they're using to support us, and they're taking it away from our kids' prosperity. That's why we need to have private investment and private economic growth rather than government economic growth.
Yes. Now, I just want to finish up on the last little bit that's come out from the RBA. So the statement of budget policies that's come out. I think the thing I have to highlight is their changes in the inflation headline and trim mean.
Please.
The one that matters to me is the fact they think that inflation at the midway point of this year is going to be 4.2% from 3.7% on the headline and 3.7% on the trim mean from 3.2. They don't see it getting back into target until the end of 2027 in terms of that headline figure. I think the way to look at this then is this is a really, really hawkish story, and they are clearly very worried that our spending is a problem, and until we get a handle on it, we are going to go through what is also fascinating here, a very, very dreary GDP session as well, looking at those figures on the top line and the fact that by the end of this year, they think GDP will be 1.8% down from 1.9%.
Wow, was this? Yeah. So
June 2028.
Fiscal policy, politicians, Jim, if you're listening, I know he watches.
He watches.
Hey, mate, let's do something about productivity. Let's start thinking about removing all the red tape.
Can I also say, hey, mate, you don't have to wait till an election to actually act.
Yeah.
Let's do.
And now you've got a bit of headway there. I mean, I know you're going to do more taxes. That's just what you have to do. Let's make them smart taxes and maybe broad-based in some respects, rather than isolated to the property investor. I almost got through a whole show without complaining about what happens to property investors, but I'll finish with that.
That's next week's job, right?
Well, that is, look, the reason why rents are going up is because the governments are putting in all this regulation and all of these higher operating costs. And guess what we're doing? We're passing it on to our consumers or our tenants because we have to, because we're going backwards in holding those properties. And we don't want to be going backwards. We want to provide private, safe, quiet rental accommodation and have some support for our families in the long term. So there you go. Make sure you read our disclaimer. Until next time, we're going to wrap up by saying the US story is going to impact the global economy. The Australian story is one of pumping the brakes. Sounds like we're going to have to pump again. Next RBA catch up where Evan and I will update you on is the 17th of March. Looking forward to that. And always remember, this is not investment advice. Have a good time. Until next time, remember, knowledge is empowering, but only if you act on it. Bye
See you
for
guys.
now.